Hello, everyone. My name is Brian Wong. I'm a Senior Tax Manager with Moss Adams, based out of our San Francisco office. Today, we'll be discussing the ASC 740 tax implications of the COVID-19 updates. Our agenda for today is as follows. We want to discuss the SEC filing date that has changed, the income tax considerations, the deferred tax implications, implications on the valuation allowance, and interim considerations. As you may know, the SEC on March 25th extended the temporary 45-day grace period for companies affected by COVID-19. This will impact SEC reports, for example, 10-Ks and 10-Qs, originally due on or before July 1st, 2020. There are a number of income tax changes as a result of the COVID-19 tax updates. Here are a few examples. For instance, the federal net operating losses have been changed, the rules have been changed so that NOLs arising in 2018 through 2020 can actually be carried back 5 years. Further, there is an elimination temporarily of the 80% taxable income limitation for tax years 2018 through 2020. Qualified improvement properties placed in service in 2018 and after now have a 15-year maker's life and 20-year ADS life, if elected or required. This now makes qualified improvement property eligible for 100% bonus depreciation. A couple of other changes. The Section 163J interest expense limitation increased from 30% of taxable income to 50% of taxable income. This is applicable for tax years 2019 and 2020 for corporations and applicable for partnerships beginning in tax year 2020 only. Further, alternative minimum tax credits are now fully eligible for full refund in 2018 or 2019. And then finally, the last one we're going to go through is that cash charitable contributions, the limitation is going to increase from 10% of taxable income to 25% of taxable income for 2020. Now, the deferred tax implications of all of these. As you may know, effective changes in tax laws on deferred tax assets is recognized in the period of enactment, which is March of 2020. As a result, to the extent that you have federal net operating losses that originate in 2018 and 2019 that you are expecting to be carrying back to pre-TCJA tax years, those NOLs may need to be revalued. For instance, back in pre-TCJA tax years, the maximum federal tax rate was 35%. Further, if you are expecting to receive a refund within 12 months due to the carryback, you would need to reclass it to income tax receivables. As far as the qualified improvement property, to the extent that you have an increase to your 2018 to 2020 NOL carrybacks, the DTA for the qualified improvement property may also need to be revalued at a different tax rate. Valuation allowance considerations. As you may already know, valuations need to be reassessed at each reporting date. Due to significant disruptions to companies' operating results, potentially, COVID-19 may need to be an additional consideration for whether a valuation allowance is needed. If operating results deteriorated due to the fact of COVID-19 that was not known previously, it is appropriate to revisit prior conclusions. Further, source of taxable income due to the temporary removal of NOL limitations to 80% of taxable income, the realizability of deferred tax assets may change. As far as interim considerations goes, companies may have an impact on their forecasted full-year profits due to COVID-19, which would have an impact on the company's estimated annual effective tax rate. Effects of a change in tax law on taxes payable for a prior year should be recognized on enactment date discretely. For example, adjustments to companies' deferred tax assets due to an NOL carryback would have to be recognized discretely in the quarter of enactment. Effects of a change in tax laws on taxes currently payable for the current year is reflected in the computation of the company's estimated annual effective tax rate. We hope that you found this update useful. Thank you for your time.